Everybody, and welcome once again to this edition of the monthly market equity insight. And joining me today on this webinar is Ajay Tyagi, our head of equity and fund manager. So he's going to be sharing this webinar with me. And as usual, of course, we've also got my colleague Niranjan from the product team joining us on this, and he's helped put together the slides, some of which will hopefully address questions that you might have. And of course, we've already started to receive many of your questions, so we'll be tackling some of those questions at the end of the presentation deck, where I will cover the sort of macro outlook for earnings, and then Ajay will talk about the Flexi Cap equity fund strategy. So that's going to be the agenda for today. So without any further ado, I'll just request Niranjan to bring up the slide on the screen. Hopefully that's visible to you. So here we are again. This is the 7th edition during the current calendar, July 2023. So, let's quickly look at two slides, which are, slides that we've sort of picked to give you a sense of what's happening in equity markets, what's happening in terms of some key data points. Now, I'm sure all of you have heard about how India has been doing quite well in a global context. So here we've just highlighted one single data point, which sort of shows the attractiveness of Indian equities to a global audience. This is the 2-year earnings growth for various developed and emerging markets. So these are the earnings growth over CY24 or FY25 compared to CY22 or FY23, as the case may be. And as you can see, the fastest growing market among these range of economies shown here is India, where earnings growth is expected to be almost 34% over the 2-year period ended FY25. And there's only one other country matching this kind of growth rate over 2-year period. And then you see some other emerging markets which also have fairly strong growth over that 2-year period. But India head and shoulders above most other markets, and certainly well above the sort of global MSCI average earnings growth. So that's one of the things which continues to work in India's favor, which is the strong growth outcomes that we are expected to register in the future. Moving on to the next slide. And the reason I highlight this is that I'm sure many of you are aware that foreigners have been significant sellers of Indian equities going back to almost somewhere about October of 2021. So almost for 18 months, they have been net sellers of Indian equities. You can see that on the chart, which is visible, the sharp drawdown over there in that line, indicating the reduction in foreign ownership of total market. At the peak, foreigners owned almost about 21% of the market, and at the recent trough, it had fallen by almost 4 percentage points to about 17% of total market. Now, in the last few weeks, we have seen net buying by foreigners, and therefore that line has gradually started to go up again. But in a context of how high foreign ownership has been in the past, we have been significantly higher at closer to 21%. I'll also point out that, there is a sort of self-balancing nature of this equation, because we have seen significant domestic flows come into the market. And therefore, as a result of that, domestic ownership of markets has gone up quite significantly, primarily through mutual funds, but also through direct ownership and also through insurance. So domestic institutional ownership of equity markets is now just a shade below total foreign ownership of the overall markets. But again, much below the kind of highs we have seen in previous decades. So there is some buying which is happening currently, but the aggregate level of ownership is almost 400 basis points below where we were much earlier. So if we just move on from that to quickly look at where we stand in terms of some economic trends. I won't spend too much time on this, but this slide shows you the longer term economic trajectory, and then it shows you the current quarterly forecast for quarter by quarter. And then finally, it also shows you the financial year forecast for 3 years, FY23, FY24, and FY25. And as you can see, India's GDP growth estimate is at about 6% for the next 2 years. And I think that's a reasonable estimate given the kind of momentum that we currently have in the economy. The current account deficit used to be a source of concern, but from a trend line where it had reached almost 3% of GDP immediately after the Russia-Ukraine conflict, it now looks like it's headed back to about 1.4, 1.5% of GDP, which makes it very comfortable from the point of view of the central bank in terms of managing monetary policy and also managing the inflation target that they are expected to achieve. If you move on from this to the next slide, I won't spend too much time on this because this is a high frequency indicator, but broadly I would just point to the fact that most indicators pointing in the right direction, be it automobile sales, fuel consumption, bank credit growth very strong, deposit growth slightly lagging, and that's a reason why there is some tightness in the market that we are experiencing in terms of cost of money. But broadly, I would say everything ticking along in a fairly steady direction. Global economies are facing some kind of slowdown much more than India, and that is reflected in the foreign trade export number. If you look at the foreign trade export line, you can see in April of 22 we had hit almost the 40 billion mark in terms of exports. That number has drifted down now to about $35 billion. So there's some softness in exports which is now visible. But let's move on from these economic indicators very quickly to look at the equity markets and valuation. Where do we stand in terms of that? And first, we'll just stand with what have markets been doing recently. And obviously, it's been a bumper 1 month and 3 month period for the Indian markets. Small cap index up almost 20% over a 3 month period, and the Nifty 50 up about 10%. So strong outperformance by the small cap index of the large cap index. On a 1 year basis, the gap is slightly more narrower, but the Nifty small cap doing better than the large cap index. But best of all has actually been the mid cap index. In the last 3 months, I think ever since RBI went into pause mode, we have seen some of the more interest rate sensitive areas do well. So the best performing sectors on a 3 month basis are Nifty real estate and also Nifty auto, which typically are sectors that we consider to be a lot more sensitive to rates. Interestingly though, on a 1 year period, Nifty FMCG, one of the best performing benchmark indices, though I would say that's also significantly pulled across by its biggest weight, which is actually ITC, which is a tobacco company, but that's what has really pulled that up. But banks, both PSU as well as the aggregate private bank index, have done extremely well over a 1 year period. So banks is something that we've discussed several times in the past, and that's been a sector which has certainly been dominating market strength over the last 1 year or so. If we jump on from that to look at how India has been doing relative to the rest of the world, on a 3 month basis, we have done extremely well. But I would say on a 1 month and year to date basis, India is somewhere in the middle of the pack. In fact, I would say one of the most remarkable rallies year to date is actually happening in the US market. If you look at the US NASDAQ, it's up almost 30% year to date. The NASDAQ alone has added almost $6 trillion or more in market cap during the current year YTD. This is driven significantly by the strength in technology stocks and particularly by, I think a lot of strength in companies which are seen to benefit from the growing investments happening in artificial intelligence. So that's really been the sort of bellwether market year to date. Artificial intelligence and the NASDAQ, those have been significant drivers of market performance. performance. And as a result, even on a one-year basis, you can see India, of course, doing quite well, but the US as well, up quite smartly in the S&P 500, but the Nasdaq itself actually beating the Indian market on a one-year basis. Right at the top, you may be surprised, Germany and France among the best performing markets in the world. But remember, right now we are comparing June end to June end, and last year during this period, the European markets were particularly beaten up by the Russia-Ukraine conflict and concerns about how they would deal with the energy shock that they were facing, both in terms of supplies and in terms of cost. But from that depressed base, both those markets have come up quite smartly, as these markets have navigated the supply issues of energy quite well. So that's why they're at the top of the charts. Moving on from this slide to the next one, which talks about earnings. So the consensus forecast for March 24 and March 25 is about a 16 to 17% earnings growth for that 2-year period. So remember, that's the source of the 30% plus earnings growth that we saw in the initial chart for a 2-year period. So this sort of results in India having one of the best earnings outlooks over the next 2 years. If you look at how earnings forecasts are behaving for the current year and the next year. So in the middle of this, you can see the 4 bars for FY24, and these show the trend line trajectory of earnings during the quarter ended June 22. How did they change in September 22, December 22, March 23, and now July 23. So as you can see, between March 23 and July 23, there has been a cut of about 2% in the annual, or rather in the earnings estimates for March 24. And similarly, if you look at the earnings estimates for March 25, there has been about a 2% cut in the earnings estimates for March 25. We are almost at the start of the earnings season for March 24. I do expect this to be a very strong quarter, because remember, this is the quarter where even in India, there was the maximum amount of pain on account of the Russia-Ukraine conflict, which showed up in earnings numbers. So I do expect the current quarter to be very strong, but as far as the full year number is concerned, I think there are headwinds. That's what is reflected in the 2% cut, and we'll talk more about that when we move on to subsequent slides. But the next slide, quickly talking about valuation. Left-hand side is the trailing PE multiple of the Nifty 50, somewhere between the yellow line and the red line, which means it is above average in terms of valuations, but at the same time, well within the comfort zone. If you look at the forward PE multiple, it was well within the comfort zone in February of this year, but with the recent rally, it has pushed slightly into the expensive zone, at least in terms of earnings. What does it look like in terms of price to book? We can see that on the next slide. The price to book multiple for the Nifty 50p price to book. I'll just wait for that to come up. Yeah, there you go. So this is still slightly below the red line. So again, above the long-term average, but not particularly in expensive territory as yet. So I would say the overall message from particularly Nifty 50 valuations is that we are getting close to rich territory. It's not as attractive as markets were 3 months ago, and certainly not as attractive as markets were somewhere in about May, June of 2022. Valuations sort of getting closer to the rich and expensive territory. And this is very interesting because remember, the market itself has moved up only by about 4 or 5% compared to October 21. So sometimes people feel fearful saying, oh my God, market is at a new high. Does it mean this is a bubble? Now, I would only say that in any investor's lifetime over 5 years, 10 years, 20 years of investing, you're going to see multiple lifetime highs, most likely. What is more important is what is the valuation. That is more important than the absolute level of the market. And at this point of time, valuations are still slightly softer than where we were in October 21. So not cheap, but not as expensive as October 21. And I would say still somewhere in the upper reaches of fair value. What do valuations look like when we look at other segments of the market? Let's say the mid cap and the small cap. The mid cap, remember we were saying a few months ago that it was trading more in line with the large caps, very much in the attractive zone. That has spiked up. Remember, the best performing part of the market on a 1-year basis is now the mid cap index, and that has spiked up now to just sort of enter the expensive zone. The small cap index on the right hand side, I must say this has surprised me. This was an area where we had more concerns relative to large cap and small cap, but these valuations have really spiked once again into the expensive territory. And I would say just from a valuation standpoint, I would still be a little bit more nervous on the small caps as compared to the mid caps and the large caps. So quickly, we'll just move on now to look at the yield gap side of the story. How does the inverse of the Nifty PE multiple compare to the 10-year bond? Now, again, this was a line that was moving in favor of equities. But remember, in the last 1 month, equities are up. Bond yields have also spiked up, and therefore actually this indicator has moved away from incrementally in favor of equity to sort of moving back away from that average. So there's a sharp sort of movement which has happened in the Nifty yield versus 10-year GSEC, sort of moving the needle slightly in favor of fixed income at this point of time. Moving on from that, I won't spend time on this slide because we already covered this in terms of the fact that mid caps trading in line with large caps. So what are our key takeaways at this point of time? I think the most incredible takeaway is really how strong the US economy has remained in the face of such unbelievable interest rate increases. Remember, the policy rate has gone from 0 to 5.25. We are now expecting a further rate hike in the meeting happening in this month, and markets are expecting that there could be one more rate hike which happens during the current calendar. Just 2 months ago, the markets were expecting that 5.25 was the peak, and there was an 80% probability that a rate cut would happen by December 23. So from an 80% probability of rate cut, we have now moved to 100% probability of one rate hike and some probability of a second rate hike happening during this year. Why has this happened? Very simple reason. The US economy continues to be very, very robust. On Friday, we got the employment data for the US, 209,000 jobs added. This is still better than the jobs that they were adding pre-COVID. So very, very robust economy. Inflation is trending down. The Fed's favored rate of inflation is down to about 3.8%. But remember, that target is actually 2%. So they are still 2% away from their target. Whereas, in India, of course, we are slightly more generous with our target system. We say 4 plus or minus 2. But right now, our reported rate of inflation is closer to 4 than it is above 6. Whereas in the US, they're still almost 1.8% away from target. The MPC, therefore, in India is on pause mode, saying they think they've done most of the heavy lifting as far as rate policy is concerned, but they're not ready to reverse policy as yet. They're still saying their policy stance is withdrawal of accommodation, and the RBI governor in particular, Governor Shaktikanta Das, insists that the target is 4% inflation, and therefore I think what he's pointing to is don't expect any rate hikes anytime soon. Rate cuts anytime soon. Nifty FY24 earnings estimates, I would continue to believe that there are some headwinds to this. Why? Because the Indian economy's nominal growth rate this year is going to be much weaker, maybe somewhere high single digits, 8 to 9%. The global economy, particularly China, Europe, definitely under pressure. US doing slightly better than anticipated, but still I think it's overall a headwind that at some point the US could also eventually, see a slowdown in growth or a mild recession, simply because rates have moved up so significantly. So fiscal and monetary policy settings across the world, including India, are currently restrictive, and which is why I think there is a downside to both growth estimates and earnings estimates. Equity valuations still in the comfort zone, but now they are well above average, and they are at that point where we would start to worry that any more strength in equity markets will push them into what we consider to be the rich zone. Our preferred strategy for investors is to continue to adopt a staggered investment strategy towards equities, and that's simply a function of where the valuations are. So I think that's sort of, the lay of the land that I wanted to put out today to leave you with a sense of where we are in the market cycle, the earnings cycle, and the economy. So I'm going to pause over there and request Ajay to come in now. And Ajay will be talking about the UTI Flexi Cap Fund, which is his quality growth strategy that he manages. Over to you, Ajay.
Yeah, thank you, Vetri, and good evening, everyone. So I think before we go deeper into the fund and the strategy, it's useful to actually very quickly go through the core philosophy with which we are running this. And on your screen, you can see three very, very simple tenets of our philosophy. We start with quality, and we never lose sight of quality, whatever be the market mood, whatever be the the sectors or the kind of companies which might be getting rewarded. We will always stick with businesses which we define as high quality, and we have a very simple definition to define quality. Quality businesses are the ones which are profitable as measured by their return on capital employed or return on equity. And because of their high profitability, these companies and these businesses generate strong cash flows. So high ROC businesses also end up generating strong cash flows. And because they have strong cash flows, they basically have very strong balance sheets with actually low to no debt on these balance sheets. And in fact, a strong amount of cash sitting on them. So this in short is basically how we define quality. And like I mentioned, we will always remain financial markets over many decades has taught us that eventually such kind of businesses end up creating wealth for investors. Yes, they do also try and test your patience because there is no one strategy which can always work in all four seasons. But patience is well rewarded in such kind of businesses, and that's something which we remain convinced about. Uh, we move on from quality because our strategy, like Vetri said, is not just quality, it's quality growth. So within this universe of quality companies, we look for businesses that can continue growing faster than India's nominal GDP, which basically means that we love owning companies that can grow in the mid-teens, maybe 15, 16%. Of course, there would be certain companies in our portfolio which can grow even faster. They could be growing in their 20s, but the portfolio as a whole is designed with the endeavor to have growth outcomes that are in the mid-teens. And I will show that to you in the subsequent slide. So we start with quality. Within the universe of quality, we look for high growth companies which can persist with faster growth for the foreseeable future. And towards the end, we have a sharp look at valuations. Before I just go into what is it that we look for when we are valuing companies, I must make a point here, which is that we never start with valuation. So if our analysts, especially for this strategy, were to come to me and say that look, company XYZ is trading very cheap, it's perhaps the cheapest company in the sector, you may want to have a look. I would say that our starting point is quality. So first, you need to assure me that this company is one of the best quality companies in the sector. So valuation is never the starting point for us. Valuation is the last point or the ending point for us after we have satisfied ourselves on the quality and sustainability of growth of a particular business. Then we start to look for what could be the right valuation for the company. And again, very simply put, we want to be approximately right rather than being precisely wrong. So valuation is one of those things which nobody can ever point a finger at and say that, look, this is the precise value of the company. Valuation always works in a band. What we try to look at is a band of plus minus 10 to 15%. If companies are trading within that band, we are happy to slowly and gradually increase exposure. One of the ways that we tackle high valuation of companies which we end up buying is basically a SIP kind of approach. So just like investors and advisors, you are used to not timing the market, but to gradually invest your money into equities over time, trying to catch the ebbs and flows. Likewise, when we discover a great company, instead of hurriedly buying it and building a big position, we take months and quarters, sometimes even years, to slowly and gradually catch the ebbs and flows of the market to build position into such high priced companies, or companies which typically never trade at a discount, or either trading at fair value or maybe sometimes even higher than fair value. How we make money from these investments is on account of the fair value of these businesses, which continues to increase. So we are not buying companies cheap. We are not making money because we are buying something which is worth 100 rupees, but we are buying it at 70, with the difference, which is 30 rupees being our profit. We are perhaps more often than not buying 100 rupee worth of businesses at 100 rupee itself, but it's the quality and growth of these companies which keeps increasing the intrinsic value, and that is how we create our alpha or create wealth for our investors. Yeah. Now, with this in mind, I think this snapshot should give you a very good idea about whether we are able to walk our talk or not, whether indeed the portfolio is high quality and high growth or not. And therefore, we thought it's best to just look at the sales growth and the profit growth of our portfolio over the last 3, 5, 10 years. And like I said earlier, we do have a portfolio which has been growing in the mid-teens and growing, let's say, 3 to 4 percentage points higher than the relevant benchmark, both at the revenue level as well as at the profit level. When it comes to return on capital, again, our companies are more profitable, which is demonstrated by the fact that their return on invested capital is about 5 to 7 percentage points higher than the benchmark. Finally, I spoke about the quality of the franchise also manifesting itself in its strong balance sheet with low to no debt. If you look at the debt to equity of our portfolio, which is nothing but the aggregation or the accumulation of all the companies that are there in our fund. So the debt equity of individual companies multiplied by their weightages is basically what these numbers are. If you look at that aggregate, it has always been a negative number, which means that we've had our companies on the aggregate, or our portfolio on the aggregate, has never had any debt. It's basically a portfolio which has cash on the balance sheet. So that itself represents a portfolio of strong companies which can withstand a lot of these economic ups and downs and remain profitable. Yeah. Now, moving on, while the strategy which I spoke to you may sound very, very sensible, indeed, like I mentioned, if an investor has been following this with discipline through years and decades, he or she would have made money, and we are convinced that the strategy would deliver strong outcomes for us in the long run. But unfortunately, markets have a mind of their own. Markets test the patience of every investor, every strategy, and like I mentioned, there can never be a strategy which works in all 4 seasons. Very simply put, the chart in front of you is basically a comparison of the 2 most popular styles practiced in the market: quality versus value. We all are aware that value has been doing very well in the last 3 years. If you look at this chart, which basically gives you a 17-year history ever since these 2 indices came into existence, which is 2006, you would see that once every 1 or 2 years, there is no fixed frequency, by the way, there is no fixed tenure or time period, but every now and then you see the baton being passed on from one style to another style. So there are times when value does well, as represented in the yellow shaded areas. There are times when quality does well, as represented in the blue shaded areas, and it just keeps changing all the time. The reality also is that while we are talking about what goes into our fund, which is basically the quality and growth businesses, the other important aspect to be a successful investor is your own behavior. And the reality is that when investors see that their portfolio is not working, their strategy is not working, they start to lose patience in the first year itself, By the end of second year, most investors start to turn mad and they just can't accept to the fact that what they have is not working and what the others have is working. And inevitably, by the third year, investors throw out what they own or they have been holding on to buy something, which has been doing very well in the market. That's the typical behavior of investors, and that's why multiple studies have shown that you see the fund return in its entirety is never captured by investors. Investors end up actually having a return lower than what that fund would have delivered in the long run because of this behavior of theirs to just jump from one to the other. We keep reminding ourselves as investors that styles keep rotating and changing. If the strategy is sensible, then you just need to stick to that strategy. And during this time when our performance has been poor in the last 1 year in particular, which has also started impacting our 3-year performance numbers, we are just reminding ourselves that what you see on this chart is a fact of life. Styles keep rotating, and if we are convinced about the companies that we are holding in our business, then we just have to keep patiently holding on to them, till such time that markets start to reward quality once again. Moving on. This is a very quick summary and a representation in terms of a graph of how we have performed during different market cycles. On the top, you see how the quality benchmark has performed against Nifty 500. Once again, the green areas are basically when quality has outperformed the broader market, which is Nifty 500. The gray or the black areas are the ones when quality has underperformed the broader market. That's the top chart. If you come to the chart below, you again see the greens and the blacks, with green being the time periods when we have outperformed the broader market, by which I mean when UTI Flexi Cap has outperformed the broader market, which is Nifty 500, black being the time frame when we have underperformed the broader market. If you try to actually look at the top and the bottom chart together now, you will see they are highly synchronized, highly congruous. The greens at the top correspond to the greens at the bottom, and the black at the top correspond to the black at the bottom, which basically means that while we have underperformed, we clearly have underperformed when quality has not been working. But like I mentioned, reversion to mean is a fact of life. And if we are indeed holding strong businesses, then not only will we revert back to the mean, we will end up creating alpha clients in the long run. Yeah. Just two more charts which I want to show you. For those of you who are interested in knowing that have we witnessed this before, have we seen such kind of underperformance in the past, and if we did see this underperformance, how did we recover and what was our behavior in the subsequent years? This is basically our history going all the way back to 2010 and the phases of underperformance that we have had. Actually, if you were to compare these phases with the chart that I showed you earlier, you'll realize that these were all phases when value was doing well, quality wasn't doing as well, and therefore we were also underperforming. But the point is that because we persisted, because we just continued with our style, because we just held on to our portfolio with conviction, we ultimately were rewarded in the subsequent time periods. Holding on to this same portfolio meant that after undergoing the pain in the subsequent periods, we generated strong realized alpha against Nifty 500 in the subsequent periods after suffering a correction. Another way to show this chart is on a 1-year basis. Another way to show this is a 3-year bar chart, which basically again shows that in that phase of 2017 and 18, we did suffer a 3-year negative alpha. And this was just during the time when value was doing very well. But in the subsequent periods, we did end up creating strong positive alpha, which unfortunately in the last 1 year has again turned into negative alpha. But we remain hopeful about the outcomes of the companies that we hold in our portfolio. Yeah. Moving on, another important point which I thought is worth reiterating here is this question about what's the importance of timing in these businesses. Because more often than not, we get this question from investors that, look, we know that the quality of the portfolio is good. We know that these are great companies, but is this the best time to buy these companies? I mean, shouldn't we wait for their valuations to correct? I would say that yes, like I mentioned initially, we never go all in once we discover a new business. We are very patient. We build our position over many, many quarters, taking advantage of the market volatility. But we would also not want to wait indefinitely. We would want to be approximately right rather than being precisely wrong. Rather than saying that, look, great business, but not the right price to enter, we would just let it pass. Instead of that behavior, we want to be gradual. And this chart in front of you tells a very important, kind of insight, gives a very important insight into, these high quality businesses in terms of whether buying them at a particular point is important, or can you buy them in a disciplined manner and benefit from them? So just like all of you have been doing SIPs, and all of you, I'm sure by now have realized that SIPs indeed are the best way to get investors invested into equity market, to build their asset allocation into equities and so on. In a very similar way, we said that, look, let's pick up these high quality companies from our UTI Flexi Cap portfolio, and let's just build two scenarios. Scenario number one is almost like an SIP investment. We invest on 1st of Jan every year for 10 years. Without trying to time, we just say that, look, 10 years should capture all the ups and downs. Let's just be patient and let's invest for a 10-year period. Let me start with a company like Ajanta Pharma. We invested 1 lakh rupees on 1st of Jan starting 2013 right up to Jan 2022. The value of this 1 lakh rupee of investment over 10 years has now become 38.64 lakhs. The second scenario is someone who says that, look, great company, but I need to buy it at the right price. I will wait for the prices to correct. And this person ends up buying Ajanta Pharma every year at the lowest point of the year. So the 1 lakh rupee invested here right from 2013 to 2022 is at the lowest point of each year. And this corpus grows to a figure of 41.76 lakhs. The difference, as you can see in the third column, is basically just about 8%. The value of these two investments is basically having a difference of only 8% over a 10-year long period. This again goes to show that what is required in while you make a portfolio of high quality and high growth companies is your ability or your behavior to hold on rather than to time it. And let me show you another interesting statistic which has been compiled by Niranjan. If you go to the rightmost column, the most astonishing thing is no matter how strong the quality of a company, all of these companies witness a very sharp correction or a drawdown. And we have taken the cutoff as 20% more often than not. So in the last 10 years, Ajanta in 7 out of 10 years has seen a correction of more than 20% in any particular year. Same is the case with a high quality company like Asian Paints or a Havells. Even a company like a HDFC Bank or a Nestle goes through, such kind of heavy drawdowns at least 3 times in a decade. On an average, if you look at this group, you would see the average comes to around 6 times. So more than half of the times you see massive drawdowns in these companies. Instead of waiting for those times, if you can have a model where you keep investing gradually, take advantage of these times whenever they arrive rather than wait for them, I think that's a more sensible strategy for such companies rather than trying to time them. Yeah. The next slide is basically our portfolio spread across large, mid, and small. Our portfolio has a very high active share. Please don't confuse this with the portfolio churn. The portfolio churn is very low, around 10%, because we want to hold on to our businesses for long. But the active share is very high, which means that we are very different from the benchmark. We don't believe in constructing a portfolio which is close to the benchmark, which tries to hide behind indexing and wants to hide behind certain large cap exposures in the benchmark. We are fine and comfortable owning businesses where we are convinced rather than looking at what's there or what's not in the benchmark. Next one. Yeah, so a quick snapshot on the top 5 overweights and underweights. Let me start with the underweight. Yes, these are very big weightages in the benchmark. Reliance Industries almost 7%. We are zero. ITC 3%, zero. TCS, a great company at some point of time we used to hold, but then we realized that it remains a high quality company, possibly doesn't have the ability to grow in the mid-teens. That's the number that we typically love to have in terms of the growth outlook. So we exited TCS, bought in a mid-tier IT company. LTI is now the largest holding in our portfolio and also the largest weight within IT. So, what we don't like, we typically would make it zero. What we like, even if it's a very low weightage in the benchmark, we don't mind, having it as a top 5 or top 10 holding. On the right-hand side, you can see that there are many sectors which are just marked down to zero because we are unable to find high quality, high growth businesses in sectors like oil and gas, metals, construction, power, reality, and so on. Sometimes we suffer because of this, because when these sectors do well, we do suffer. But it is our belief that we have to look at returns and investment outcomes over a fairly long cycle rather than just 1 and 3 years. So moving on, the last slide here is basically just our belief in terms of running this strategy, and we've just tried to sum it up in a few sentences. We feel that the greatest edge that an investor can have is a very long-term orientation. Often short-term performance envy causes most of the shortcomings that lock investors into a perpetual cycle of underachievement. You're just looking at what others are doing, trying to ride on momentum, and that's a very, very dangerous strategy, because there would always be something doing well in the short run, but that may not make sense, and that may not be, sensible for your strategy. But to be a disciplined investor, you need to have a philosophy and stick to it, even under pressure. And most importantly, be willing to stand by and watch others make money. I think that's what has been happening to us over the last couple of years. But we remain, solid in terms of our belief in the strategy, and and also in terms of the stocks that we hold in our portfolio. So with that, I would just want to end my part, and we can open up for questions now.
Thanks a lot. We will now move on to take the questions, and thanks for that useful thoughts. So we have received a few questions, and over the next 15 to 20 minutes, we will take them. So here is the first question to you, Ajay. So as you alluded, the portfolio churn of UTI Flexi Cap has been in the range of 10 to 15 in the longer period of time. And in fact, the current portfolio churn, so as of June, and it is around 7%, right? So what is driving your conviction on the portfolio companies?
Sure. So, Narinder, it's not materially different from what it has been. Like you rightly said, it's been between 10 to 15%. It may be 7 or 8% today. I think what's led to this number be even lower than our anyway very low band is the fact that, what we are owning in the portfolio has been significantly punished in the last 1 or 2 years. And these are businesses which I have seen, which I have known for, in some cases for as long as a decade. And our understanding of these businesses is very, very deep. So when these businesses are trading 30, 40, in some cases even 50% lower, it is only sensible to actually increase exposure in these very businesses rather than go out hunting for new ideas. So that's been our approach in the last 12 months. Perhaps that's why the number is slightly lower than the band that we usually guide to.
Sure. Thanks for that clarity, Ajay. Thanks. So the next question is to Vetri. Vetri, so while the earnings face headwinds from slowing economy, fiscal and monetary restraint, so what is the probability of market consolidation in the near term on the back of a weak global environment?
I wish I had the tools to be able to make a forecast of when the market will consolidate and when it won't, but that's not my skill set. I think we react more to where we think valuations are unattractive or where they are attractive. You could actually argue, Niranjan, that literally the last 18 months are nothing but one gigantic consolidation, right? Because as I said, over the last, almost 20 months maybe now, because we saw peak somewhere in October 21. So we're almost about 20 months down the road from there. Markets have gained about 4% point to point over that period. So it's one gigantic consolidation period during which markets have not done too much, earnings have gone up, valuations have derated. I wish we had the tools to be able to forecast when a market will go up, when it will go down, when it will consolidate, but the reality is that we don't. And therefore, I think from an investor's point of view, it's always better to think about what is the valuation, and does this provide me with an opportunity to be more aggressive or to be conservative, or just to sort of disregard the risk and try to even it out by benefiting from volatility through staggered investing. So really that's the perspective that I would provide.
Yeah. Thanks, Vetri. So here is the next question to Ajay. So Ajay, this is a question coming from Mr. Deepak Karnik and a couple of others. So the question is on the valuation of mid and small caps. Given that they continue to be stretched, what is the strategy adopted at UTI level to mitigate the expected drawdowns, if any? And also if you can throw some light from Flexi Cap Fund point of view.
So let me start with the UTI view here. So I think we are very, very clear that we have to follow the mandate which is given to each fund. So as you're aware, we run a mid cap fund and a small cap fund. And there, instead of again trying to time the market and bring in the view that we hold about the valuations of these companies, we would just, and perhaps because of that, hold on to some cash or reduce mid caps, increase large caps in the fund, and so on. We would remain true to mandate, true to the objectives. We will continue running these funds as mid caps and small cap fund respectively. But yes, within this universe, we will try to actually have a portfolio of companies which and the argument never starts only with valuation, which are great businesses to own, and then B, are in terms of valuations also attractive. So it will be a combination of things, but we would never, while Vetri keeps giving his views around large, mid, small, each of us keep telling you about our views, but we would never let those views impact the objectives of the strategy. From a flexi cap perspective, yes, once again, I should say that just because mid caps are more expensive doesn't mean that we are actively selling mid caps and buying large caps. For us, it's the view on the business from a 5-year perspective that is more important. If mid caps are trading expensive, then like I mentioned, instead of basically building a new position in a mid cap, which could have been done in 2 or 3 quarters, maybe I would take 6 quarters to build that position into a mid cap just because the valuations are very expensive. And equally, if the valuations of mid cap were to turn attractive, instead of waiting for 3 or 4 quarters, maybe we build that position within just 2 quarters. So I think valuations just are one of those factors which tell us how much time should we take to build positions. Should we wait out or should we just accelerate, and so on?
Yeah, sure. Thanks, Ajay. So Vetri, in your initial deliberation, you alluded to exports, and it is getting moderated in the recent months, is what you said. So there is a weaker demand from India's export market. Primarily, the exports is with the US and EU market, and also partially compensated by in the recent time export to China, right? So how is the export mix likely to shape up going forward, and what are the likely drivers of growth?
Narendra, that's a very difficult question to answer. I think there has been some shift in the pattern of India's exports. Not so much, I would say, just the geographical, but I think the more important change in India's export pattern is that we have sort of shifted away from exporting low value added goods to higher value added goods, meaning things like gems and jewelry, minerals, those as a percentage of the export basket have come down. High value add, which is more manufacturing products, it could include pharmaceuticals, all those kind of value added products, the exports have actually gone up if you look at the overall basket. And of course, as some of you would be aware, in recent years we've had some success with electronics exports as well. Again, over there, the extent of value addition is not clear because significant amount of the components are imported and only assembly is done here in India. But again, it is value added in a small margin, so it would add to the overall share of value added exports happening out of India. So to my mind, that's the more critical change which is happening. It does two things. It moves India up the value chain. Secondly, it creates high quality jobs in the organized sector for India's youth. And in order to realize the demographic dividend that we talk about, it's important to be able to create those better paying jobs in the organized sector, and clearly manufactured value added goods is the best way to do that.
Sure, Vetri, thanks for that. There are a couple of questions on sectors, so we will take them now. So this is a question to you, Vetri, again. So although there is a good recovery in volumes of auto sector, they are yet below the levels of 2019. So for some of the categories, so what is actually delaying the recovery, and how much is already priced in its valuation?
Yeah, good question, Ranjan. So I would say each part of the automobile stack is operating at a different speed. If we look at tractors actually went past the pre-COVID peak the first. Cars in the current year will comfortably surge past the 2019 peak, well on track to go ahead of that. If you then look at commercial vehicles, my sense is by the time we get to FY24 end, we should once again sort of overtake the previous cyclical peak. It's only two-wheelers where we are still running below the previous peak, almost in double digits, and maybe that may take all of 24 and 25 to sort of completely recoup. It's also partly a reflection, Niranjan, of the fact that it is a little bit of a two-speed economy. In general, higher income segments have come out of the COVID pandemic much better placed in terms of their spending ability, and things which are lower down the income spectrum have tended to do slightly worse. So I think that same distinction is visible when you look at high-end cars vis-a-vis commuter motorbikes, right? So in a way, that's the same difference which is showing up. But I do think almost all of the automobile sector by FY25 would have recovered to cyclical peaks, and that does mean that they are all experiencing the benefits of operating leverage, even though, and therefore earnings will be well supported. Though from a valuation standpoint, I think the sector is now sort of more mid-cycle.
Sure, Vetri, thanks for that. Ajay, there's a question on IT sector coming from Mr. Manish Manipal. So what is your take on current valuations of IT sector on the back of subdued growth outlook? And what is actually driving the overweight exposure in your fund again to this sector?
I'll take the second part of the question first, Niranjan. I think the overweight is on account of our bullish stance on the way the world is embracing technology. I think it will not be wrong to call this as the technology age. Just like in history textbooks, we have learned about the Bronze Age and the Iron Age and the Industrial Revolution that happened 100 years back. I think the way technology is touching our lives and the way technology is touching both consumers and businesses, to our mind, we are convinced that technology spends will continue to increase globally for many, many decades to come. Now, IT services companies are at the forefront because while they may not be innovating, but they are the implementation partners whenever a new technology comes up. If artificial intelligence comes up, I can assure you that the implementation partners would have to be Indian IT services companies. So I think our bullish stance is emanating from there. Now, in this long-term bullish stance around IT, there would obviously be years of slowdown. There would obviously be years of strength. We try and value companies not only from the next 1 year or next 2 years, but from a medium to long-term perspective. And therefore, our view on IT from a medium to long-term perspective remains solid. It's one of those sectors where not only growth is good, but balance sheet cash flows are extremely good, and so is the capital allocation. So yeah, I mean, it will remain for the foreseeable future one of the core holdings for us. Yeah.
Yeah, sure. Ajay, thanks for that. The next question is on healthcare sector. So again, back to you. Healthcare sector continues to lag behind other sectors, right? So despite of various favorable growth drivers being in place. So what are the factors hindering the sector's growth outlook or its expectations?
Sure. I think in case of healthcare sector, you're right. The long-term growth drivers are solidly there. Increasing disposable income itself is the single biggest driver of healthcare spends in India. And this healthcare spend will manifest itself into multiple things, into pharmaceutical sector, which is people buying more medicines, into the hospital sector, also into diagnostics. Apart from this, the other end of the market is basically export opportunities. It could be generic exports. It could be exports of ingredients, active pharmaceutical ingredients and intermediates. And the last part, which is significantly catching up, is being a research partner to many of the global innovators at a very early stage, at the level of clinical research itself. So I think all of them have their drivers. We are slightly wary about the generics part of the business, especially the US generic business, because of the massive price-led competition there. But for all other segments, we remain confident about growth in the coming years. Please don't extrapolate the events of the last 18 months into the future. The last 18 months, the pharma sector had a very bad patch because of two main reasons. One, huge amount of inventory destocking. During the pandemic, for the whole of 2020 and 21, the world went through a massive stocking up of medicines. But because the pandemic suddenly went away, these medicines were in abundance. They were in huge, they were lying in the stocks for most, countries. And therefore, there was a phase of destocking. The second thing was margins actually getting impacted for these companies across the value chain, because rising commodity prices, rising crude prices, and there are a lot of crude derivatives that go into the pharmaceutical value chain. All of that led to margin pressure. I think both events will get corrected in the coming 6 months to 12 months. That's why I said, please don't extrapolate the last 2 years to be, a sign of things to come in the coming 3 or 5 years. Yeah.
Thanks, Ajay. So fair enough. Vetri, there's a question to you. There is a reasonable evidence that investors who are in the pursuit of earning better returns tend to give more importance to timing their investments, right? So in the process, sometimes may even underappreciate the portfolio risk, right? So is this due to behavioral gap? And what is your take on this?
Sure. I think, a lot of investing has actually got to do with emotional quotient, not necessarily with intelligence quotient. And that's pretty much what, the master himself, Warren Buffett, says. He says it's more EQ than IQ. And I would tend to agree, because, investing doesn't really require you to know higher level calculus. It's fairly straightforward. Actually, you could argue you don't even need too many spreadsheets. Most of what you need to do about investing, you can actually do with a pen of paper and a pen in terms of the calculations that are required. But I think, what challenges people is really the sentiment and the news flow. The reality is that when the news flow is extremely positive, that is when valuations always tend to be very rich. And at that time, people have a fear of missing out. They want to participate. They want to feel that bullish fervor. Similarly, when the times are very adverse, the news flow is terrible, valuations are, maybe cheap, but nobody wants to be there, because it just feels like a very painful period when, stocks are getting hammered and nothing really seems to be working. And therefore, they are not able to be contrarian, and they typically end up chasing fads, and they typically end up exiting the market at the most inopportune time. And that's why there is a behavior gap which opens up, which means the return shown by the investment is much higher than the return earned by the investor. And that's because the investor chose to jump in at the wrong time and also jump out perhaps at an inappropriate time. Maybe they shifted strategies at the wrong point of time, or as you said, timing, they exited the market at the wrong point of time. So a lot of this can be avoided by investors, investing in what we call asset allocation schemes in terms of SEBI categorization. These are schemes like the balanced advantage category or the multi-asset category, where there is an underlying model which determines the level of asset allocation, which is driven by fundamentals, not by sentiment. And therefore, by calibrating the level of exposure to equities, you are able to enhance risk-adjusted returns. But more importantly, you are able to participate in the wealth creation available to you in equities without necessarily experiencing that entire volatility that is associated with it, which in turn therefore causes the sentiments, the emotional responses, and the behavior gap. So, I think for those who wish to outsource asset allocation to the investment manager and say, here's my money, take it, maybe even a lump sum, but then allocate it to the asset class which looks more attractive and manage it for me over an entire cycle, these set of funds become a very good opportunity set to look at.
Thanks, Vetri, for that insight. In fact, there is a question on asset allocation. I'll come to that. Before that, last question to Ajay in the interest of time. So how could investor use various equity funds at UTI for diversifying their portfolio risk and aim to generate stable returns across the market cycles? So if you can share some insights here.
Niranjan, I'm sorry, because of poor audio, I couldn't hear the question. Can you please
repeat the question? So how could investors use various equity funds at UTI for diversifying risk and across the market cycles?
Sure. So, again, the audio was poor. So I'll just very quickly summarize my thoughts of whatever I've understood and then pass it on to Vetri. So I think, so the asset allocation thing that Vetri was talking about in the previous question has to be taken to the next level. Once you've decided to allocate capital to equities, you also need to be mindful of the fact that you cannot put all eggs in one basket. You just need to have funds which try and cover the different segments of the equity market. I did show you the chart where we talked about the most popular styles, value versus quality, and so on. I would say that, in a way, it is incumbent on us, our advisors as well, to let investors know that the best strategy when they are building in an exposure into equities is to spread across, a growth fund, a value fund, to invest into large caps, to also have some allocation to mid caps, and so on. At UTI, we are trying to practice all of the styles in different ways in different funds. So I would say that for people who are wanting to actually invest into the market by investing on the basis of the market capitalization segmentation, as also on the basis of the style segmentation, we have different combinations which are available. And I think that indeed is the right way to actually approach this, because you and I can keep arguing about what will do well in the next couple of years, but there is indeed no scientific sure way of predicting what will happen. I'll just pass this on to Vetri because this is an important question for all our investors. So Vetri, maybe you can just chime in here.
Sure. So I think it really goes back, as Ajay rightly said, the first level, there's asset allocation where you're trying to minimize the volatility inherent in equity by allocating across different asset classes. You could also do that for the very obvious reason that you have different needs in terms of cash flow and the certainty associated with it. So therefore you use, maybe typically equity and fixed income as two asset classes to achieve that objective. And then because we know the equity market has seasons, these could be seasons in which a particular market cap is favored. This could be a season in which a different style is favored, growth, value, GARP, so on and so forth. And therefore, there is some level of style diversification as well, which helps within a portfolio. And that's what, Ajay was alluding to. And I think at UTI, one of the things that we would always say is that we run a very wide range of strategies, everything from very traditional value to quality growth at the other end, and various strategies that fit somewhere in between. each of these would tend to create very strong variations in their alpha cycles relative to their own respective benchmarks. So you could use these to once again sort of try and make sure that you're participating across market cycles.
Thanks, Ajay and Vetri, for that useful insight. One last question to you, Vetri. So maybe after this, you can conclude the webinar for the day. So in the current environment of stretched valuation of equities and looming uncertainty in debt markets, what could be the ideal strategy for investors looking for risk-adjusted returns over medium to long period?
I'm not sure there is an ideal set of numbers that I can point to in that context, but let's just clarify 2-3 things. Look, market are at all-time highs. Valuations are not at all-time highs, right? Valuations are actually lower than where you were in October of 21 across a range of parameters. So let's separate market high from valuation high. Is it a market high? Yes. Is it a valuation high? Answer no. Of course, as I said, it's not a cheap market. It is, nearing rich territory. So I think you've got to be cautious in terms of how much you wish to allocate towards equity. It can't be near the top end of the range for sure. And that's why we were actually saying that this is the kind of time somewhere in the middle of that comfort range where staggered investing works better than anything else. But for those who say, look, I don't want to stagger, I just want to put one investment and forget all about it, then I think the asset allocation strategies are best, because even if you invest a large sum in those, the underlying fund will only make an allocation to equity in line with what the valuation model is telling the fund to invest in equities, and therefore the asset allocation is automatically taken care of there. As far as fixed income markets are concerned, I'm not sure I understood that part of your question, Niranjan, but I think the Indian markets still are reasonably in stable state. It's really the US market where, as I said, the economy has been unbelievably resilient, and therefore it's almost a game of chicken and mouse, where continuously the Fed is trying to scare the markets and the economy by taking rates higher, but so far the economy hasn't really blinked at all. But I think therefore the tension in the bond market is much higher in the US, not so much in India, and which is why if you see, and actually not in most emerging markets. So if you actually see over the last 1 year, the sort of typical correlation we have seen between developed market bond markets and EM bond markets has completely broken down. Previously, if you saw pressure in developed bond markets, EM bond markets would have a crisis. Right now, EM bond markets are actually an oasis of stability, and it is the DM bond market, which is particularly the US, which is where you are seeing these very strong tensions and conflicts. So I would say in India, not so relevant. But anyway, thank you, Niranjan, for all those questions. Hopefully, we've been able to address many of the questions that came in. We try and combine common questions and answer them. But delighted to have all of you send us on these questions. Do continue to engage with us in the Monthly Market Equity Insight. Send us your questions, and we'll be back next month again. But thank you from my side, Ajay and Niranjan, for joining us on this call.
Thank you.
Thanks.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.